Welcome everyone to Cyber Trading University. My name is Adam Rosen. Very happy you could join us. Please take a moment to look out at our disclosure, risk disclosure on the screen. Please ensure that you're always aware of the risk involved in any trade and that you only trade with the risk capital. Okay, let's get started. Today we're going to talk about hedging our equity portfolios with stock options. We're going to talk about the fact of why would we want to hedge, why now in particular this time of year. We're going to talk about covered calls, protective puts, about techniques to hedge volatility, as well as time decay. Now, to start off, why would we want to hedge? Over the past couple of years, we've seen tremendous moves in the equity markets to the upside. The Dow has moved from 6,500 to new highs almost every single day. Quite a few of us probably have long-term positions in a 401k or in some sort of portfolio that we don't necessarily want to get out with. To get out of that position for a number of different reasons. First of all, a lot of these positions pay dividends. The high dividend paying stocks like AT&T, Verizon, the dogs of the Dow, as they're called, it really does make a difference over the long term to collect the dividends and to reinvest them. Also, if the stock like AT&T happens to be in a long-term trend to the upside, well, there's very little reason to want to get out of the stock, even if we think there's a minor pullback. I mean, after all, investments are meant to ride the waves of rallies and sell-offs. And also for tax purposes, some traders, it does make a big difference to some if we day trade or we hold positions for more than a year at a time. So at times, it may be advantageous to hedge our long-term positions for a couple different reasons. Number one, seasonality. That the old expression, sell in May and go away. During the summertime, the markets do tend to fall under pressure. There's, of course, market uncertainty, which we haven't lacked for that over the past couple of years. Changing monetary policy tomorrow. Federal Reserve Chairman Ben Bernanke will speak. Well, he will release the minutes from the most recent meeting. And some economists, a lot of people in the media suspect the fact that the Federal Reserve may take away quantitative easing, at least pare it back, sooner than the end of the year. And some have forecasted this may occur as soon as the summertime. If that does occur, if quantitative easing is at least even pulled back, we might expect weakness in the equity markets. Rising volatility, we're going to take a look at some charts that compare volatility to the progress on the equity markets. And there's an inverse correlation, which means when stocks go up, volatility drops. But when volatility rises, stocks tend to go down. So we can hedge ourselves against rising volatility. And of course, time decay, also known as theta, when we're dealing with one option versus another. Now, first way to hedge a normal stock position is through covered calls. How many people here are familiar with covered calls? I know it's probably the first thing that you learn in option school. It really is. It's the most simple strategy. What it basically does is covered calls are designed to protect existing positions and also to generate additional income along the way, especially as volatility in the markets cool off. For every 100 shares of an existing position, we sell one covered call. What it is we're long, 100 shares of a stock, and the stock's $50 a share. And we believe that the stock may encounter some resistance, that it might not go up for the next few days, weeks, or even a month at a time, maybe in the summertime. Maybe we want to protect ourselves through earnings season where if there's bad news, that could adversely affect the stock. So we sell a covered call. The opposite of buy a call, we sell a call with the anticipation the stock will not go up, stay flat, or maybe even go down. The strike price that we choose to sell the covered call should be based on our near-term expectations of where the stock will trade to. In other words, if the stock is 50 and we're still quite bullish on it, but we want to generate some additional income and maybe hedge a portion of our profits, we would sell an out-of-the-money call. Is everybody familiar with the terms out of the money, in the money, and at the money in terms of options? If you're not, please let me know. I'd be more than happy to go over it. Essentially, if you have a stock that's $50 a share, A call, which is an option that you would buy in anticipation of the market going up more, it's a bullish bet. An out-of-the-money call is a call that's still out of the money, meaning it's above us. It's above the $50 current price. It's at a price that we think the market will go to. In the money is below the current stock price. So the stock price is 50, out of the money would be 55, in the money would be 45, at the money would be exactly 50, exactly the same price as the current price of the stock. If we're bullish on our existing position, we can sell an out-of-the-money call. I have an example to show you to better illustrate this. If we're neutral or on our existing position or maybe slightly bearish, if we're very bearish, it probably makes sense just to sell the stock. But if we think the stock will stay neutral in a trading range, maybe come down a couple points, but we're still optimistic over the long term, we would sell an in-the-money or an at-the-money call, which just means we're going to generate more premium and buy more protection. It also limits our upside, which we'll see, but it also buys protection. Our maximum profit is the strike price of the short call minus the purchase price of the stock plus the premium that we receive. So the strike price of the short call, we'll see in the next example, is 55. That's where the call option that we're selling is. We bought the stock at 50, so the difference is 5 plus the premium that we receive. We'll show you in the next slide a great example that demonstrates all this. The max profit is achieved if the stock closes at or above the strike price of the short call. Basically, whatever call we sell, we're stating that's the ceiling. We don't think the market will go up anymore. So it limits our profits. Our maximum profit occurs if the stock goes up to the strike price or above that. But if we want more profits, we have to sell a call higher up. The maximum loss, the maximum risk for this type of trade is very simply the stock price. You know, we buy a stock, it's $50 a share. We have 50 points in risk if we don't place a stop order. But we take a little bit less risk than that because the premium that we receive from the call option we keep. So we'll show you the next example. And that occurs only if the stock obviously goes all the way down to 0. Okay, first example. We're going to buy 100 shares, and let me know if I've gone through any part of this too fast. I assume it's old hat for most, but let me know. I'll be more than happy to slow down and go back if it's necessary. Buy 100 shares of XYZ stock at $50 a share. We decide, okay, I think the stock is neutral. Long term, it's good, but right now, I don't think it's going to do very much. We sell a call option with a 55 strike price. We're selling the right to somebody else, whoever's on the other side of the trade. Whoever buys a call option has a right to own the stock at $55, no matter where the stock goes afterwards. I'm selling him that right. For that privilege of owning that right, he has to pay me $2. If the stock closes at or below $55 a share, the strike price, the option's worthless. If it goes above 55, me as a seller of the call, I'm liable for anything above 55. Now, to take this option alone would be very, very risky. But remember, we're also already long 100 shares of the stock. This is a covered call, so it's a package. It's a package of 100 shares long stock and 1 contract short the call. Everybody get it? Now, we sell the 55 strike price. We collect $2 in premium. The maximum profits for this strategy is the strike price of the short call, which is $55. Take out my magic marker here. Okay? So the strike price of the short call, which is 55, minus the purchase price of the stock, which is 50, plus the premium received, which is 2. So 55 minus 50 is 5. That's the difference between the short call and the purchase price of the stock, plus $2 premium gives me $7 potential profits. This will occur, and the easiest way to remember this is this occurs if the stock closes at or above 55, which again is the strike price of the short call, the 155 call, the 1 contract of the call of 55. Okay? How does this work? Well, we own the stock right now at $50 a share, right? Let's say between now and then, between now and expiration, the stock goes up to 55. We've made $5, 5 points on the stock investment, but because it closes exactly at $55, the entire premium that we collected, the $2, we keep. So we made $5 in the stock trade plus $2 in the premium. We made $7. Now, what happens if it goes to 56? Well, now we'll make, if it goes to $56 a share, we'll make $11 in the stock trade, but we'll lose $1 on the call, which means we're liable for $1. So we still net, sorry, it's not 1 because it comes out to 7. $7 profit. $7 profit is our maximum. Okay? So we'd still end up with 7 net. We would make $11 in the call and the remainder in the option, the 4. Okay? Very good. Now, maximum loss. If the current stock price drops to 0, $50 a share goes to 0, we lose obviously 50 points, but again, we get to keep the $2 on premium. So 50 minus 2, 48 maximum loss. That's obviously assuming that we're going to hold on to the stock until it goes to 0. Let me ask everyone a question. What happens if a stock goes down 5 points and the $2 premium that we collected, you know, that's a 55 call. Now, when the stock is 50, it's worth $2. What's the chances of that call being worth anything if the stock drops a lot? Maybe 0. So I'll put this question out, see if anybody knows. If the stock drops, let's say 5 or 7 points, and the $2 call that we sold is now basically 0, and then we want to get out of the stock, what would be the appropriate measure? The stock drops a lot, the call that we sold goes to 0, but now we're nervous about the stock itself dropping a lot more. What if we just want to get out of everything? I can't get out of everything now. I'm basically giving a hint here. You can't just close out the stock trade if you're still short the call, because without the stock, if the market goes up a lot, you could lose a lot of money on the naked call, which is exactly right. You buy the call back. It's $2 a share right now, but if the stock goes down, you know, a couple dollars, this might go down to 0. So what you do is you buy it back. And a lot of options brokers, what they'll do is that they'll allow you to buy back those very, very cheap options. They understand why. You know, why would someone want to buy a 5-cent option? Because you want to close the contract. So they'll give you a reduced commission if you're buying a contract that's less than a couple pennies. And I think the reason they did that is to allow traders to sell out, to close out of their options, you know, if they wanted to get out of the stock. I think that's probably the reason why. Maybe because enough people ask for it. I mean, it doesn't make sense to pay a lot of commission on a 5-cent stock, on a 5-cent option. So, protective puts, number 2. Now, when we talk about covered calls, we have to understand that, let's go back for a moment. We go to our example. The stock is 50, we sell a 55 call for $2. If the stock goes up to 55, we're going to make $7 if that's all we're going to get. There's a limited profit as far as what we're going to get. What if the stock goes to 100? It doesn't matter. We're locked in with that $7 maximum profit potential. And if the stock goes down, it goes down a little. That's fine. You know, we keep the premium. We get, you know, we have $2 of protection. You wonder how much protection you have. It's whatever the premium is. So you had $50 of risk on the original stock. Now you have $48 of risk. So a covered call is a conservative way to take a little bit of premium, you know, get a little bit of potential profit, a little bit of protection, but it's not a very big umbrella if you think about it. A covered call is not really, I mean, you know, I know the title of the seminar we're talking about, hedging. Technically it is a hedge, but it's almost like a diet hedge, you know. I mean, if you have a $50 stock and you get $2 of a hedge, how much does that really help us? Selling covered calls is, I think, you're not thinking in terms of risk. You're more thinking about I'm moderately bullish or I'm neutral. It's a way to generate income is what it is. If the stock, question is, if the stock goes above 55, why not buy the call and let the stock run? You certainly could. You know, it's a great question. What if the stock goes to 55, right? The 50 goes up to 55. Okay, the stock is 55. We'll make $5 on the stock, and obviously the $2 premium will probably be worth, it's not going to be worth 7 exactly, because we have to talk about the delta and the Greeks, the calculations. It's not as smooth. It's not a one-to-one relationship. Okay, but we'd make $5 in the stock price, and so we'd have to take a loss. Okay, we've made $5 in the stock trade, but we've also lost $5 on the option. So now our cost basis for the stock is not 50. The cost basis for the stock is now 55, approximately. I mean, it's, we have to talk about the Greeks. It's actually a lot more of a complicated calculation. But theoretically, the stock goes up $5, the option goes up $5. That means our new, if we're very, very optimistic on it, like if you think that, oh, wait a second, earnings has come out tomorrow, and I have the suspicion that Amazon's going to buy them, if you're that optimistic, then yes. But just understand, if you close the option, you're going to take a loss on the option that will be compensated by the gain in the stock, but you end up raising your average cost basis. The risk is that you take a loss on the option, and then you take another loss on the stock if the stock turns around. So if it all depends on our outlook for the stock. If all of a sudden one of the competitors in that stock's sector said, you know what, we're the biggest and we want to buy a company, and well, I'm not saying anything, but that company looks like a great candidate, then yeah, close the option for a loss and ride the stock up. You're absolutely right, bud. You got to have an indication the stock's going to go much higher. Don't try to squeeze like another, 50 cents out of the trade. I mean, that's for a blowout kind of idea. It's a great question, though. Okay, but okay. So again, covered calls. It's more of a way to generate income. You do get a little bit of protection, but I mean, look, 1% is not really what I consider a hedge. If you want a better hedge, if you're coming into you own the stock, it's a long-term investment, but, this quarter hasn't been good. You haven't seen a lot of people in that store, whatever store, that stock represents. Earnings season's coming out. Maybe you're really nervous what the Federal Reserve is going to say. If you see, you want to hold on to the stock, but you see danger signs ahead, this is a better way to go. This is more focused towards downside protection, protective puts. It provides insurance, and it's exactly what that is. It's insurance. It provides insurance in case the stock in question moves lower any time before expiration. For every 100 shares of an existing long position, we buy one protective put, which stands for 100 shares, which represents 100 shares. Maximum profit is the current stock price minus the strike price of the puts minus the premium paid. And again, we have an example to show you how this works. The maximum profit is achieved as the stock price continues to move higher. So you have a $50 stock, and you spend whatever amount of money on the puts. The put below us will expire worthless. It's like car insurance that we never use. It's a good thing. If you're long the stock and it goes from 50 to 100, you spend $2 on insurance. If it goes from 50 to 200, you still only spend $2 insurance. So it's whatever the stock goes up minus your insurance. That's the best way to think of a protective put. The maximum loss is only the premium that we paid on the puts. You can never lose. If you just buy an option, you can never lose more than just how much you spent on that option, if that's just one single option alone. Maximum loss occurs at or below the strike price of the put option that was purchased. Here's an example. Okay, we buy 100 shares of XYZ stock. This top, I just repeated the rules, so we know where we can reference them. We buy 100 shares of XYZ stock at $50 a share. All of a sudden, we start to realize, well, I don't feel so good about this idea anymore, but I want to hold on to it. So I'll buy a protective put. with a $50 strike price. It's an at-the-money put, which means the strike price is the same as where the stock is right now. For the insurance, we have to pay a premium. We pay $2. In the covered call example, we collected $2 that hopefully we're going to keep. In this example, we're spending $2 that hopefully we won't need. If the stock trades from 50 up to 60, we've made $10 on the stock investment. Remember, we're still long the stock, minus $2 in insurance, which is the put. So we net, we make 8. If the stock goes up another 10 points, we've only spent the initial 2. If the stock goes down from 50 to 40, the loss is only the $2 paid in the premium, which means theoretically, if the stock goes from 50 to 40, we lose 10 points in the stock investment, but our $2 put goes up by 10, meaning it goes to 12. Now, that's the theoretical rule. And that means that if the stock moves between here and there is on expiration day. However, this only tells a very, very small amount of the story. You see, the options price, it does not have a one-to-one relationship with the stock. When the stock goes up $1, the option doesn't go up $1. The option is affected by three a lot of factors, but 3 major ones we call the Greeks. The delta, which represents the rate of change in the stock to the rate of change in the option. The theta, which is the amount of time decay. And the vega, which represents volatility. And volatility, as that changes the value of the option. By the way, I mentioned this before, or maybe I didn't. Tomorrow noon, we're starting a workshop that I'll give you the details about afterwards. We go into a lot of depth. It's a huge presentation. It's about 24 PowerPoint slides. You know, it's way too much, I think, for a 2-hour presentation. It's a 2-day workshop. We're going to talk all about the Greeks, the delta, the theta, and the vega, and an entire array of option spread strategies. Vertical spreads, calendar spreads, condors, butterflies, you know, credit and debit spreads, etc. Okay. I'll give you more information on that later. Does everybody get it so far? Stock goes from 50 to 40, we lose 10. Theoretically, the option, I mean, at the end of the day, by expiration, that's the value you're going to get. You will make $10 on the 10 points to the downside. The question is, how much is it worth in between now and expiration? That's where the Greeks really become important. Okay. Now, we sold covered calls to generate income and minor hedging protection. We bought protective puts for major hedging protection. We can also hedge against volatility. As equity markets rise over time, the volatility tends to decrease. You ever noticed recently the stock market goes up, but it goes up in little fits and feats. 15 points up, 40 points up, maybe 100 on a good day. But when the stock market goes down, it doesn't go down 20 points at a time. It goes down 200, then 400, then 800. The VIX. Is everybody here familiar with the VIX? Is anybody not familiar with the VIX? For those of you in our cyber group, in our morning meetings, we talk about volatility a lot. So I'm sure you're probably very familiar with it. Also with Stephanie's stock classes, of course. If you're not, let me know, because it's very, very important. The VIX is a volatility index. The symbol is actually VIX. It represents, it's also known as the fear index. It represents the premium paid on the S&P 500 options, meaning when the market volatility increases, usually when the market goes down, the puts and calls both become more expensive, and the VIX index, the fear index, rises. It goes up when markets go down. When markets are scared, the VIX rises, the fear index. Historically, the VIX is usually between a range of 15 and 40. Remember, when it's down near 15, it means markets are complacent, quiet, everybody's happy, we're going up every day, not a lot of volatility, not a lot of risk. When the VIX goes up to 40, it means there's a lot of fear. The fear index went up to 40, option premiums are wider, there's more volatility, and usually stocks have gone down a lot. I asked in the last session, and quite a few people knew, I'm curious, anybody in the session, does anybody know where the VIX closed today? Remember, fear occurs near 40, and safety, we feel safe around 15. I'm sure people here know. Where was the VIX as of the close today? I didn't even look. In our last session, we got a couple quotes, 12 point something, closer to 13. The VIX has been very, very low for a very long time. Some people will attribute that to quantitative easing or the Federal Reserve monetary policy in general. Needless to say, that's one of the reasons why we know stocks have been so strong. And not only to look at the stock market every day, but also the VIX is very, very low. Okay? Now, in addition, if we want to protect ourselves from a rising VIX, a very simple way to do so is to purchase an out-of-the-money call option on the VIX, meaning to buy a call option maybe a little bit above 15. And what that would accomplish is, let's say we have an entire portfolio of stocks. We have 20 different stocks, but it says the VIX today was 1337, up 2.69%. 13, thank you very much, by the way, is unbelievably low. Sometimes, in the old days, we would not see a reading below 15 more than maybe once or twice a year. We've had a consistent 15 VIX since January. That's how much quantitative easing, I would say, the monetary policy has created a level of complacency. Option volatilities are at historic lows, even as we come out of earnings season. Now, one way, again, to hedge your portfolio, let's have a portfolio of 20 different stocks, IBM, AT&T, Verizon, we have all of them. If we buy put options or sell covered calls on every single one of those, we have to pay spreads, commissions. It can get very costly. If we want to hedge our entire portfolio, we can buy out-of-the-money call options in the VIX, or even at the money, or in the money for that matter, depending on how much protection you want. So if the stock market declines and our overall portfolio declines, the VIX will rise and our call options hopefully will compensate for those losses. However, the caveat is that the equities in our portfolio should have a high beta to a high beta overall. What's a beta? A beta is a measurement that calculates the correlation between our stock and the S&P 500 index. When the beta is 1, there's a strong correlation. It means when the stock market goes up, our stock goes up. A beta of -1, I think, is a reverse correlation, a negative correlation, and a beta of 0, I think, is just no correlation. We want to see a high beta, up to, I think, 1 is the maximum. 1 would be a 1-to-1 correlation. The S&P goes up 1%, our stock goes up 1%. It's important, and you can check to see the beta of your stocks. A lot of websites, if you plug in the symbol like Yahoo Finance, they'll tell you what the beta is. You want to make sure you have a high beta stock because you're hedging the portfolio with the VIX, which is based on the S&P 500 options contracts. So if the stock market goes down 300 points tomorrow, the S&P goes down a lot, and our stock has a low beta, our stock might not go down. Therefore, or our stock might go down, and while the stock market does not go down, therefore the VIX would not rise, we would not get the hedging protection. The hedge only works if the stocks in our portfolio have a high beta. Here's a picture of the VIX. This is really cool. On the left-hand side, we have a VIX of 79. I know intraday and actually intra-week, we probably had levels a lot higher. These levels are, I believe, are monthly closes. But we had an absolutely historic high in the VIX in late 2008. My chart says near 79. I know we were actually higher than that. The first time we've seen those levels probably in a decade, I'm assuming. Okay? So the VIX in 2008 was at 79. Take a look at the stock chart. The Dow Jones Industrial Average, 2008, down below 8,000. We actually went down to 6,500. Strong VIX, weak stock markets. Number 2, April 2010, VIX goes down to 16. Stock market has a major reaction. From April through May of 2010, the VIX goes from 16 to 41. April, the VIX was at 16, stocks are very strong. May, VIX goes up to 40, stocks go down very quickly. I think this was the flash crash a couple of years ago we had. Remember when the stock market went down very, very quickly all at once in one day? I believe that was April of 2010. So if somebody knows, be curious to see. I'm pretty sure it was. Now, the VIX goes down to 14 April 2011. Stocks recovered from a flash crash and really rallied. The VIX in August of 2011 went up to 43. April 14, August 43. April 14 VIX, 13,000 Dow. August 2011, 10,000 Dow, 43 VIX. Everybody see that? It's an opposite correlation. Now that the VIX is near historic highs, take a look at the charts to where we are now. This is unbelievable. To be below or at 15 since January at least, it's huge. You know, you look historically, we're a lot lower for a lot longer now. I mean, even below 20 is considered optimistic. We were only below 20 for a short period of time and only very, very briefly after 2010. So, not to, be so bold as to call the market, because the Federal Reserve still is printing money and there's a lot of moving pieces, in this picture. But needless to say, if history's any judge, and a 15 VIX is a sign to, you take a look at the last time the VIX hit 15, what weren't too bad of sell signals. And to buy the VIX, to buy the market when the VIX is up near 40, or in this case 70, but here's a 40 and here's a 40. Dennis asks if you can buy VIX call leaps. I think you might be able to. Excellent question, by the way. And I'm really glad you mentioned it because I had the same thought. I said, well, why don't I just buy way out call options, 1 year call options, January of 2014, January 2015. I have very little time decay because it's they're very long term, and eventually if the market goes up between now and 2015, we got a really good chance to, make some progress, really make some money, right? I think that's true. I think that you plug that into an options calculator. I think that, certainly, I mean, if you have, I don't have the options platform in front of me, but if you don't mind, look for the 2014 that expire in January of 2014. Look for the 15 calls. How much would the 15 calls be for January of 2014? I'm curious. A little experiment will run here. So January 2014, how much would the 15 calls be? The 15 Jan calls. Oh, only goes to October 2013? Maybe that's why. But to answer your question, I mean, look, I think it's a strategy if they offered. I'm sure there's some way to buy long-term options and volatility, but I think we can do a better job than that. I think if we follow the fundamental story behind the market, I don't want to get too off topic here, but if you follow the fundamentals, and the fundamentals are the central banks, now more than ever, we can do a much better job at timing when to buy these call options. We might not get the lowest price, but I think we'll be on the right side. Be patient, though. It takes a long time to reverse monetary policy. All right. Last but not least, I want to talk about hedging. It's a great question, though. Really, really great question. Hedging time decay. This does not apply so much to those of us who own stocks, but if we own a long-term option, which, by the way, is called a leap, if we buy an option for more than a year, that option tends to lose money over time. All options are depreciating assets because of something called theta, which is time decay. Now, true, longer-term options are less affected by time decay, but if you buy a long-term option, you will notice, even if the market doesn't move, you will notice that option will start to lose a little bit of value over time. Time decay accelerates as the expiration gets closer. The greatest amount of depreciation is always the front month, the current month. The June options decay, lose value a lot faster than the Julys, and the Julys faster than August. In addition, if you look into it, online or in a book or something, they'll talk about the time decay. It's very gradual in the beginning, from August to July, and July to June, and June to May. Well, it doesn't go backwards, but it goes down. It accelerates. The decay accelerates. The decay in the last 2 weeks of an option is unbelievably dramatic. Literally, a significant amount of the option loses value every day in the very end. Time decay is also more significant in at-the-money or out-of-the-money options because those options are purchased based on the expectation something new will happen. If the stock is 50 and you buy an in-the-money option with a 45 strike price, you have intrinsic value, which means, you buy an option that's worth something. You buy an option that gives you the right to own the stock at 45 and the stock's already 50. You already own $45 worth of that in the stock. At the money and out of the money options are future. It's a bet that something will change. So that time decay is more significant. To minimize time decay, traders tend to purchase in the money options with a significant amount of time before expiration, like 3 months. 3 months. If I think a stock is going to go up, I like to buy 3-month options. Anything less than that, I'll buy 3 months out an option. I'll hold it for 1 month. Personally, I never like to hold options in its last month. If we're going to day trade, you buy an option, a June option in the morning and sell in the afternoon, it's a different story. But as in a multi-day swing trade, I don't like to hold options overnight if it's the last month, the front month of the option. Traders may hedge against time decay by selling the front month, though. We put it on the other side. We put it in our favor. If we know the front month options are going to go down as faster than any other options, we sell a front month to hedge a longer-term option. We buy the long-term option, we sell the short-term option. And in addition, consider the fact, and this is kind of really getting a little bit into it, but consider the fact that in-the-money options retain their value more, and time decay is more significant in out-of-the-money options. What do we want to do? In theory, we want to buy in-the-money long-term options, right? We want to sell out of the money short-term. Excuse my handwriting here. That's the nuts and bolts of most option spreads, is to keep this in mind because of time decay, which is known as theta, the relationship of the stock to the option, which is delta, and vega, which is volatility. All of those three Greeks we're going to learn tomorrow in tomorrow's workshop at noon. Day 2 for this seminar, by the way, is tomorrow at 9:30 a.m. But we have a separate options seminar. It's a really great workshop. It's going to start tomorrow at noon. I'll give everybody the link afterwards. Last session we spoke about calendar spread. I know there's some people here during the last session. All of these sessions are archived. They'll be recorded, but I wanted to talk about a different strategy because I'm afraid we might run out of time. It's called a diagonal call spread, a diagonal bull call spread. Diagonal because it involves using 2 different options. We're buying and selling an option, buying one and selling the other. They're going to have different strike prices and different expirations. It's a little bit of an advanced strategy, but I promise it's actually unbelievably easy to implement. It's a bull call because it means that we're bullish, and it involves the use of call options. We're going to buy one call option, we're going to sell another, and we're going to take advantage of time decay. XYZ stock is currently trading at $50 a share, which we believe will rise over time. Now remember, the other option is you just buy the stock, but then you take all the risk. $50 a share, you take $50 of risk. And you don't get a lot of leverage. We could just buy the call, but the problem is the time decay hurts our call options. So what's another alternative where we can get better leverage in owning the stock and still take away almost the time decay? Diagonal bull call spread. XYZ stock is currently trading at $50 a share, which we believe will rise over time, and the trader's relatively bullish. What are we going to do? We're going to purchase a one in-the-money call option with 6 months expiration. Remember what we said? We want to buy the in-the-money calls with long-term expiration. The stock is 50. We're buying an in-the-money, which means it's 40 strike price. The 40 strike price is below the 50 share price. It's in the money. For this option, we have to pay $12 in premium. A lot of Novices to the options market will say $12 is a lot of money. No way. Oftentimes, though, this approach is the most logical. I'll show you why. We're also simultaneously going to sell one out-of-the-money call option with a 55 strike price that expires this month and collect $1 in premium. So we're buying an in the money, we're selling an out of the money. We're buying long-term expiration, we're selling short-term expiration. We're buying an in the money, which is 40 strike price. We're selling an out of the money, 55 strike price. Remember, the stock is 50. Everybody follow so far? Now, if XYZ stock closes at or below $55 a share at this month's expiration, we keep the entire $1 premium, and the long-term option experiences less significant time decay during the same period of time. Let's explain that now. The stock closes at or below $55 a share. We sold this call option 55. As long as the stock closes at the strike price or below, we keep the entire premium. The premium only increases if it goes up to $55.01 or higher. So this is the ideal situation. We want to keep this entire dollar of premium. And because the stock that started at 50 goes up to 55, our long option, our long-term long option that we paid 12 for also goes up by $5. Theoretically, that 12 would go up to 17, plus 1 in premium, which means 18. We've made $6 on a $12 option. That's a 50% return. Not too bad for a more conservative, safe way. Does everybody see how that works? I'll go over it again if anybody is unsure. All we're doing is mixing and matching to trying to take advantage of what's most advantageous for us. The options market just, it allows us, this is the beauty in this market, it allows us to customize a strategy not only based on whether we think the stock is going to go up or down. So much more that's involved in the stock market than just direction. We have a $50 stock. We say, well, that's a good investment. And I say, well, it has a 2% volatility. What does that mean? That it's expected to have a trading range. This is a stock, which is at 50, right? Has a 2% volatility, which over time could go up by 2%, which would be 51. 2% of $50 is $1. Or it could go down to 49. So we say, you know what? I could take this investment. I'll put a $1 stop. How many shares could I buy for an investment if I'm going to use a $1 stop? 1,000 shares. I'll risk $1,000 in this trade. But what if I were to tell you that instead of a 2% volatility, it has a 10% volatility? So we could expect the stock to go up or down $5 at a time. A $1 stop is most certainly going to get hit. We need a larger stop, which means we can afford to buy less options or less shares. If we're going to buy 1,000 shares with a $1 stop, for a $5 stop, we could only afford to buy how many? 200 shares, right? Yes, 200 shares. All of a sudden, if we're going to, stick to our risk management rules properly, we can afford to buy a lot less stock. Because it's not necessarily how much is in our account, it's how much can we afford to risk. When we talk about risk, we talk about stop orders. Now, there's no way just in the stock market to compensate for volatility unless we just simply choose to trade smaller. There's no way to benefit from volatility if we expect it to increase or to decrease outside of just owning the stock. With this particular strategy, we think that volatility will increase over time, and that we want to not be injured by theta, which is time decay. We'd like to at least break even on it. And we'd like to benefit from the stock price going up. Well, this strategy, and we're going to talk about this a lot more tomorrow, there's actually a lot more to this. You see, we also have something called the delta. The delta is a relation of the price of the option to the price of the stock. Okay? And the delta is greater in the money options, more than the out-of-money options. So if the stock moves from 50 to 55, our call options are going to go up more than our long call options will go up more than our short call options will go up, which means we might make $7 here, we might only lose $6 there. Everybody follow that? It's disproportionate because they're in the money versus out of the money. So it's fascinating when you really, once you get your head around it and you look at every single situation, every single trade. Am I bullish or bearish? What's my time horizon? And what's my opinion as far as volatility? You put together an option strategy that puts you on the right side of volatility and the right side of the time decay. Sometimes that stock doesn't even have to move and your option starts to make money on its own. You would not lose anything if it goes to 55. Well, the call would make more, the long call would make more than the short call would. Oh, I'm sorry, you're correct. If we only go to 55, we keep the entire dollar on premium. I mean, I kind of missed, I went off point from what the strategy is telling us. You know, if we go to 55, this is ours. This $1 premium is ours. Plus, we make $5. So our 12 premium goes to 17. We make $5 there plus 1 in the premium. So we actually make 6. Imagine that. The stock goes up 5 and you make $6. So really cool stuff. Let me tell you what we're doing tomorrow. Okay, first of all, we had a little homework. You know, I didn't mention this during the first session this morning, but I will now. It's meant for fun, of course. Think of any long-term stock positions that you have: AT&T, Ford, IBM, Google, Apple, whatever it may be. And let's just assume that maybe the stock market's going to go through a little bit of trouble over the next couple months. It's very plausible. I mean, summer trading. We're out of earnings season. Federal Reserve, we're uncertain of what's going to happen with the Fed. There's a few roadblocks we have to cross along the way. So let's assume that the stock market's going to get into a little bit of trouble, but you want to hold on to your long-term positions because they're long-term. Try to come up with, based on what we've spoken about, look on the options layout on Thinkorswim or Options Express, whatever broker you use. Find a protective puts. And very simply, and with these platforms, you don't even have to calculate how much risk. It has a button that will allow you to, and we're going to do that tomorrow, that will allow you to know exactly how much money you're risking or destined to make. Try those protective puts, covered calls. If you want to explore the VIX calls ideas as well, we're going to talk about all that tomorrow. Okay. Really quickly, let me tell you, okay, so tomorrow at 9:30 is the recap, well, not the recap, but the continuation of what we're doing here. Let me show you actually. Let me confirm. It's 9, these are all events, okay. This is our events calendar, by the way. You should save this link. It's a good way to go. Question is, by the way, with low volatility, I can't seem to get any premium on the short-term sale. Well, and we're going to talk about this, by the way, in the workshop tomorrow, but there's something we have to be aware of. It's called implied volatility. It's true. Most of the major measures of volatility are very, very low historically. But in certain stocks and certain issues, the high flyers, the Teslas and Googles and Apples, there is a decent amount of volatility. We talk about exactly that tomorrow's workshop, by the way. Okay, so tomorrow morning, it's a great question, by the way. Tomorrow morning, free seminar tomorrow, number 2, session 2 of what we're doing today. Today is session 1. Day 2, we're going to apply all of these strategies to the charts. We're going to take a look at real prices. If you have a particular stock you'd like to take a look at, just mention the symbol. Number 2, at 12 o'clock tomorrow, we start our options workshop. This is so much fun. I finished up the presentation the other night. You know, these workshops are supposed to be 2 one-hour sessions. I have no idea how long it's going to take us to finish. I might have to open up a third session. We have so much information. We're going to talk all about the Greeks, the delta, the vega, and the theta, and then we're going to apply those to an entire array of different spreading strategies: vertical spreads, calendar spreads, condors, butterflies, including debit and credit spreads. But we're going to take a look at how, when the volatility and the price and the time changes, how that affects the individual components in each spread. And by doing so, afterwards, you're going to know. When you look on the Thinkorswim platform, you're going to say, oh, I see where the delta is. I see where that vega is. Okay, I see what the appropriate thing. I see why I should or should not take this trade. That's tomorrow at 12 o'clock. Now, this seminar, this workshop, normally is 189. Usually the workshops are between 180 to low 200s. We've reduced the price quite dramatically. It's only $99. Originally, this was a promotion that we offered during our forex and Fibonacci session last week, but they left the link up, and a couple more people took advantage. They left a link on the front page, so we couldn't take it away afterwards. It wouldn't have been fair. So we decided this time only it's actually a mistake that we made, but we're leaving it open at $99. It's a 2-day session: Wednesday tomorrow at noon, Thursday at 5:30, and all of this obviously will be recorded, so you get the archives as well. And in the future, if we host the same webinar, if we do this again, let's say in June or July, then certainly you could also sit in for that. So, you know, it's a really great value. More importantly, though, at the end of the month, this is not on our calendar yet. Tomorrow it should be. We're going to host another Ultimate Options course. This is the big course that we haven't had here, I guess, in a long time. It's 18 hours of pre-recorded material. It's 2 months of live CyberGrip trading room access also. It's unlimited access to the live trading sessions. As soon as you sign up for this, you can participate in any subsequent course. We'll host this again probably in July or August. Not now. This is probably the only options course we have time for on our calendar. But we wanted to squeeze it in. It's a 3-week seminar. We're going to talk about option principles and terminology, risk management, covered calls, iron condors, collars, synthetic stock, historical implied volatility, and a lot more. It's basically 3 weeks, so it's learning the theory, looking for the trade. Learning the theory, looking for the trade. We're going to want you to trade a demo, an options demo count. While we're doing so, it's a really comprehensive course, 3 weeks long. If you're interested, our first class starts at the end of the month, really just like another week and a half or a week or so. Okay. On bigger and better, we're also hosting our June 4th through 7th CTU first anniversary workshop in our offices in Syosset, New York. CEO and founder Fausto Abuguisu will be here. Stephanie, she's our stock pro. Myself as well. You will also receive a free VIP ticket to the Street Monster event in New York City. That's where that option guru, John Nigerian, by far, he's the person I want to meet more than anybody. Jim Cramer will also be there, and of course, everybody from CTU will be there as well. There's a tour bus that's picking us up at Syosset and taking us through Manhattan. It's going to be a lot of fun. It's really, I mean, you know, it's going to be a room full of traders. And are they related? I don't think so. Are they? Nigerian and, I don't think so. I know what you're saying it, though. They're great guys, though. This is our events calendar. Oh, and by the way, our new social networking site, www.my.cybertradinguniversity.com, is a brand new social networking site where, whoops, oh, we have to sign in. There we go. So we're posting new material every day. It's brand new. If you do join, I would ask that you friend me. It's just like Facebook friends, but it's better because it's only in terms of trading. We're going to talk about forex, stocks, options, a lot of great stuff. If you have any questions, we do get some emails from time to time. We certainly love that. But if you post your question here, we would love it because it allows us to create a rolling FAQ type of resource for everybody. So if you have any questions, especially questions about, in general, what we do here at CTU, strategies we've spoken about, we would love if you post the questions here because we're trying to add as much content as possible so everybody could share in this knowledge base. So again, tomorrow, 9:30, day 2 of what we're going to talk of what we spoke about today. Bring your option ideas with you. And noon tomorrow, we start our options workshop. It's 189, marked down to only 89. It's an unbelievable value. You get a ton of stuff. I think I probably wrote a little bit too much. That's what I was told. But it's a lot. It's definitely a lot of value in that. More importantly, meet us tomorrow, 9:30 a.m. day 2. I thank you all very much. It's been a fantastic crowd. I'll be back in the cyber group room, by the way, 8 a.m. sharp tomorrow morning. I wish everybody a great day and a pleasant evening, and I look forward to speaking with you soon.